Hello viewers, a very happy new year. We are going to see how the market going to behave in 2023. We have come up with very good research data and stock recommendations, and you are going to get more than 20% these sectors. It's a very good idea and very good stocks. Welcome to our channel Stocks in Silence. First, let us see that news. Then last 20 years, how that Nifty 50 has performed. If you see the data in 2001, the Nifty value was around 1000 rupees. But at the same time, if you see the 2010, the Nifty becomes 6 times higher when compared to 2001. In 2010, it has become around 6000. When we see in 2020, almost double when compared to 2010. It was 6000 in 2010, becomes around 14,000 in 2020. So everybody hope is it's going to be double in the upcoming years. Absolutely, we have to see the data, then only we can predict. But the overall it looks like that Nifty 50 it's keep on growing. When we see that last year return only in Nifty, it is just 4.3 percentage. That is not even much higher. So we can say in 2022 the performance of Nifty is not that much good, but when compared to other market, it's far better. It gives only 4.3 percentage. Let us see first what are the risk factors and negative factors related to the upcoming years. Then we'll see the positive factors. We'll give the fair enough idea. So when we see the emerging markets, the Indian indexes like Sensex, Nifty and all, the emerging markets, then developed markets. First, let us see the 1 year change in the price to earning ratio, that is a PE ratio. When compared to all the markets in Indian index, particularly Sensex and Nifty, it's given the more changes, that is around 5 to 6 percentage. Exactly speaking, 5.24 and 5.27 percentage. But other developed markets, you see the US, UK, Japan, Europe, Germany, all are in negatives. So comparatively, it is better about that 1 year change in the PE ratio. But whether that PE ratio is good or bad, whether it is overvalued or not, that we have to see. The current value is about 20 for the Indian market, that is around 22 to 23. Still, I feel that it is overvalued. Let us see how the expert says. But when compared to other markets, definitely it is overvalued because all the developed markets were fell down and still it is not recovered because of that the GDP growth and the inflations. When we see the right side column, that index performance in the last year, the highest performance from the PSU bank around 70.67 and near to that same 70.69 for the SME emerging markets. So the absolutely fantastic performance from the PSU bank. In addition to the PSU bank, CPSE 23 percentage, Nifty Metal 21 percentage, Nifty private banks are 21 percentage, Nifty bank itself it's around 21 percentage, FMCG 17.5 percentage, and Nifty Auto is 15.3 percentage. So these are the gainers. On contrarily, other side is Nifty IT, Nifty Pharma, Nifty Realty, Consumers, and Nifty Healthcare, all were down more than 10 percentage. So there are ups and downs. Overall, the Nifty we have seen it has given only 4.3 percentage, but some sectors was outperformed and most of the sector was not performed well. So these are the negatives when we look back in 2022. So we'll see that one of the interview, because this interview answers many of the common questions comes in our mind. He is a person, Mr. Ajay Tyagi. He is a head of equity in UTI asset management systems. So let us see some 6 to 7 questions. What are the common questions? These questions in our mind too. So his answer will satisfy our all questions. The first one is, why should we expect from the equity market in 2023? That means what should we expect? What is our expectation from 2023? He simply says is averagely it's going to be 15 to 20 percentage premium. So I am also agree. So historically, if you see, around 10% is confirmed. So this upcoming year also, as per his prediction, it's going to give around 15 to 20 percentage overall. The second question is, the market is said to have gone through a time correction. So still Is it meaningful or did it not help? He's saying that of course there were time correction is happened. It went up to 30% higher than some small corrections. Now the value, as we have seen, the PE is around 22 to 23 percentage. Still he feels it's a overvalue. Just now we have seen the PE value when compared to other markets. So still he feels it's overvalued. Maybe another 6 to 7% corrections may be required to reach the correct value. This is the answer for the second question. Third one is, you know that many people who invest in mutual fund who entered in 2020, and then recently we might have seen many articles they are moving out from that mutual fund. They are stopping their SIP. Whether it is good or bad, the question. So he is saying that is not good, and we have to invest because it's the right time to keep our averagings, and stopping the mutual fund is not the right idea. Fourth question is also important questions. Will you remain overweight on financials? Which other sectors are you bullish on? What the question means that, and recently that finance sector was boomed like anything, whether still you feel that it is enough or it's still going to be improved, and his answer is saying that he is hoping that still there is some hope to improve further. So it's a good news for us. I'm also believing that based on the data, because multiple years that were not performed well, now it is crossed that line, so there is a hope to perform in the future also. Fifth question is, do you expect budget 23-24 will make any impact in the market? So his answer is, of course there is some part of the impact will be there, but at the same time it's not going to be much impact. On an average it's going to perform 10 to 15 percentage only. Then what is your recommendation for the investors? The investors always look into the mutual fund, and then they should look into the diversities in that mutual funds. Particularly his recommendation is a flexi cap, because they can invest in small, mid and large cap. So his recommendation is flexi cap will be the best options in the mutual fund, and investors always look into that SIP mode. The next question is, do you think technology stock will bottomed out or not, or is there any further bottomed out or not? So he is simply saying that he didn't believe it is bottomed out. There is some way, because when we compare to the Nasdaq, slightly overvalued, almost 30% is down when compared to its peak, but there is a chance to go down further around 7 to 10 percentage. But at this current situation that Indian IT sector is in the good valuation, so people can enter in that. This is what is mentioned in these questions. The last questions, what about Indian new age companies and how it is going to perform? So he says that there are depends on the company, how the company is going to perform. There is some hope for some companies, it is coming up, that may perform well. So this overall 7 question is very useful us, and it is a common question from everybody's mind. So briefly I can say that his interview is around 10 to 15% is going to give in the upcoming market. IT is in good valuations, and financial sector is also chances are there to grow, and people who are in mutual fund, they should not stop and they should continue. So these are the overall brief from his interview, because these are the common question. I am also agree with this, and he has mentioned about the positive as well as the negative and what is going to be happen after 1 years. So this may be useful to you also. Next, the very important factor, this also only one of the important article, global slowdown to a pre-election year budget, because the 23 is going to be a pre-election year. In 2024 election is going to come. So how this year is going to perform, this is very important year. So this article clearly says that there are 5 major factors going to impact. The first one is China reporting the COVID-19. So this is worrying part, because still China is not disclosing what type of variant and how it's going to be impact that market, and what is their COVID results, they are not disclosed yet. So this, if it is spreads, it's going to be a big threat to the Indian market. So this is number 1. Number 2 is the inflations and monetary policies, because already that monetary policy is not yet close, and and US still they are going to continue. How much they are going to increase in the upcoming year, there is no clarity, but there is a chance to increase further. So according to that interest rate hiking, further the market may behave. So that is a second most impact. The third one is domestic growth. Of course, GDP growth of the India, that is almost stagnant, but still we have the hope how this upcoming year the GDP growth is going to happen. According to that, the growth factor in the market is going to behave. That is a third one. The fourth one is budget. Of course, there will be some impact, but what type of a scheme and what type of new announcements they are going to give to boost some sectors, according to that, the market may behave. So, budget also may be some impact, and definitely it is a fourth factor. The last factor is FPI inflows. Of course, our Indian market is fully dependent on that foreign institutional investors, and they have come back after July to Indian market, but they didn't purchase much. So, how they are going to behave in 2023? According to that, our market is going to behave. So, these are the five major factors. One is COVID, China virus, and then inflation and monetary policies, and then GDP growth, budget, and then last one is FPI's inflows. So we have seen so far that negative factor. Now let us see the interesting analysis came from ICICI Direct. They have very positive about that Indian market, and they are saying that Nifty may touch 21,200 in 2023. So they have the valid reasons. The reason one is volatility is going to be minimized because in last 2 years, 2022 as well as 2021, the market was huge volatility. It went down, then again it went up, then again came back, then again went up. So a lot of volatility we have seen. So that will not be there in 2023. It may be in the consolidation mode. So that is a one point. The second one is FPIs, foreign portfolio investors or foreign institutional investors, whatever you call, they are showing some interest in last 6 months, and they keep on investing after July in 2022. So that will give some positive sign to come back again in 2023 January or February onwards. They will come back and they will invest further. That is a second hope. Third one is the heavyweights, particularly for the BFSI. BFSI means banking and finance sectors and insurance. That itself it's going to boost around 35%. And then technology stocks, last one and a half year it doesn't perform well, so that will help in that upcoming year. So that may help another 15% boost in our market. So all on an average around 17 to 18% their predictions. According to that, from the current level it may go and touch 21,200. So the main reason is what they are saying is volatility will be minimized, FPA flow will be high in the coming year, then preferred sectors like banking and technology is going to boost. So based on that, it may go to 21,200. So when we see the emerging markets, the Indian indexes like Sensex, Nifty and all, the emerging markets, then developed markets. First, let us see the 1 year change in the price to earning ratio, that is a PE ratio. When compared to all the markets in Indian index, particularly Sensex and Nifty, it's given the more changes, that is around 5 to 6 percentage. Exactly speaking, 5.24 and 5.27 percentage. But other developed markets, you see the US, UK, Japan, Europe, Germany, all are in negatives. So comparatively, it is better about that 1 year change in the PE ratio. But how? So this is the data. If you see only the third year of the every decade from 1983, how much percentage came, that is given here, that is around 7 percentage. 1993 28 percentage, in 2003 73 percentage, in 2013 it's a 9 percentage. So in 2023, according to the earlier data we have seen, the median is 18%. It is 100% sure. Based on this data, they are saying that the Nifty may touch above 21,000. There is no doubt, because 18% median it shows based on the historical data. So there is a surety for the 100% to reach this level based on the third year decadal cycles. Let us see. It looks very positive. When we see the data, we are also happy, but the original data is going to become in this 2023 December. Let us see and we'll believe. Second one is, as we have mentioned, we have to look back at FAA data. The FAA was the continuous seller from 2021 October to 2022 June. This is what here shows. So they sold almost all the sectors. So overall they sold around 2,56,000 crore from October 21 to June 2022. But fortunately, after 22 July, they came and they purchased around 80,000 crore. But if you see that overall 2,56,000 crore in that 8-9 months, among this around 1,86,000 crore only in the financial and technology. So it shows that mostly they have invested in financial and technology and then oil and gas, and then again among 1,86,000 crore they came back again, they purchased around 80,000 crore, almost 50% of the money whatever they sold, they came back after July and started to invest. But they didn't invest again in all only in finance and oil and gas, but they diversified. Some of the portion in financial, some of them in FMCG, some of them in healthcare, and then consumer service, and then capital goods, telecom, like that. But still they have not put their money in the technology as well as oil and gas. So this is very important data for us. So these are all in 1,000 crores. For example, in financial, they have come back in July. After July, they started to invest around 22,000 crores. But at the same time, last year they sold in technology around 8,000 crores, but still they have not put any money. So it looks like that last 6 month data, there is still hope in our financial systems, and still there hope in other sectors also, like automobile, telecom, and capital. So they may come back in 23 January also. They will start to invest, they inflow the money. So based on this data, it looks some positives as per their predictions. So based on this all predictions, like we have say systemized, like as per the ICICI Direct, they have told three key factors. One is volatility will not be there, consolidation will be there. Second is that FII inflows is high. Third one is historical data. As per the third year in the every decade, it's going to perform very well. So among these three factors, they have categorized as a 4 category. One is high relative strength, multi-year breakout, bargain buy, and market performer. What is the high relative strength means? Some new businesses come up, for example like a defense. There were no sectors. Now Indian government is more interested to invest in defense, like shipyard, flights, and military systems. So those are all high relative strength is showing in this upcoming year. In this they have suggested two, one is capital goods, another one is infra. In capital goods, L&T, and then infra logistics, Ambuja Cements they are suggesting. And multi-year breakout means you may know that there are multiple years it was in consolidation mode, now it is breaks out. So those area is showing very good, like the for best example is the financials, banks, public sector banks. So here they are recommending like Federal Bank, KEC, Techno Electric Engineering, Boots. So these are the companies they are recommending. The bargain and buy means is a very good valuations, but it may boost in the upcoming years. In that area, they are saying Sundaram Finance and Bajaj Electricals. So those all I picked up on right side. I have given these 9 stocks. They are strongly recommending for the 2023, at least it may go more than 15% income or revenue or whatever it is. It's going to provide as a profit for these investors. So it is a strong recommendation based on this category. We have seen what are these categories, how they categorized, and what is the data, why they selected those 9 stocks. Okay, this is one side. But now, what is our own predictions? Like for example, you may see that Nifty 50 it has given only 4.3 percentage. But when we see that fixed deposit rates in last year, it is more than 5 percentage. So as a common man, the people who doesn't know or who don't want to put more time on that share market, they may think like that I can put it in only in FD. Now the interest rate also increased recently in November, December. If you see the data here, if you put any bank at least for 2 years or 3 years, I am going to get more than 6.5 percentage or 7 percentage. So then why should I put more energy and every day I have to watch and every week I have to monitor, I have to read so many articles, I have to watch many videos. Instead of that, I can put my more money at least 2 years, 3 years in FD. So I can withdraw all the money in the market, I can put it in the FD, I am going to get the recent and fixed income. So these are common questions. Shall we stop investing in stock market? But the answer is no. The reason is it looks very attractive this year interest rates, no doubt. But at the same time, if you are not putting in this stock, you are losing the chance to invest and to identify, to enter in the high reasonable valued stocks like IT. If you invest this year, it may give 3 times or 5 times or 10 times more than that what you are going to get as a return in that another 2 years in the FD. So it's not a right practice to put all the money in FD. Yes, of course, some percentage you can keep as a fixed income for safety purpose, but remaining 50% you can keep on invest and identify the good stocks like the experts what they are suggesting. The next one is, as we have seen that IT is underperformed last 1 year. This is the lady like Sylvia Jablonski. She's a CEO and CIO at a Defense ETF. She is suggesting the IT sectors is going to be outperformed in another 6 to 9 months. Many people are afraid to enter, but there is a lot of scope is there to get more profit in the IT sectors. So we should keep one eye on the IT stocks. The next one is, as usual, traditionally everybody likes the gold. Let us see how this gold has performed last 1 year. That is also performed very well. If you see that in 1 month 4.4 percentage, in 3 months 10.3 percentage, in 6 months 1.4 percentage. In last 1 year, this also given 13.2 percentage. So there's nothing wrong. At least some 10 to 15 percentage you can keep on putting on gold. That is also going to give a reasonable income and reasonable profit. So gold is hello viewers, a very happy new year. We are going to see how the market going to behave in 2023. We have come up with a very good research data and stock recommendations, and you are going to get more than 20% these sectors. It's a very good idea and very good stocks. Welcome to our channel, Stocks in Silence. Next one is, when we look back at bond markets, this is the worst year we can say in 2022 when compared to other years. Last 10 years story, if you see back, the highest depreciation of money happens in this 2022. This is what the graph shows here. So almost 10% fell when compared to US dollars. Then 10 years G sectors, that is also climbed 87 bps. That is the worst case. The second one is the forex reserves almost down $70 billion in 2022. So major currencies against dollar, if you see, many of the global currencies are down like anything. Even Indian rupee also minus 10% compared to Indian. There were other currencies like Tursika, Bangladesh, Swedish, those are all more than 13%, 16%, 28%. So this is the worst year for the bond market. So better we will wait and we'll watch in the next year, then we can look back at the market. The next one is where we should put, whether we small market, small or mid cap or large cap. This data shows that small and mid caps are highly affected in this 2022. So safer side is large cap. Still there are some areas, some sectors in the very good stocks that maybe we may update in that next video. But here the bottom line message is that I will look back and then will invest in large cap only. So another one is IPO, and again 2022 also around 59,412 crore came as IPO including LIC. So among this IPO, still 71% newly listed firms trading at a premium. This is very interesting news. If you ask me personally also, I have chosen only some 12-15 IPOs that gives around 30 to 35% profit for me. So that is the biggest profit for me. When some IPO goes 200% and some IPO went up to 400%, but on an average it gives around 35%. So this also a good strategy. You concentrate on very good IPO, you apply it, even if you are not get it, if it is comes in the correct value, you can reinvest it even if you are not allotted for you. So that is always keep eye on the very good IPO with very good price. That also going to give a very good profit. So finally, what is our strategy is, instead of looking back at all the negatives, there is still some hope based on that consolidation mode, and then FA inflows as well as the DA and retail investors and mutual fund investors, they are keep on flowing. First we'll look at large caps. So as we have seen that there is a huge hope for the technology funds, and still the losers are Wipro, Tech Mahindra, HCL Technologies, Infosys. These are all this still in a very good value. If you see that value in the last 1 year changes, more than 20% is fall from its peak. Wipro under 45% fall, Infosys 20% fall, and Tech Mahindra 43% fall. It's a very good price, right time to enter in the large cap. Same way when we see that mid cap, still some technology funds also there. Apart from that, some other funds are also like ICICI Securities, Clean Science, this and Sona BLW, and then Tata Tele. These are highly affected, and it was not increased, it was depreciated. So these stocks also we can keep an eye. Same way when we look back that small caps, some of the very good stocks like the Birlasoft and then Lux Industries, the Metropolis Healthcare. So these are the very good stocks, still it's undervalued. We can look and we can invest. So finally we come to the end of the session. So what is the intelligent way to put, where to put that money? We have seen that stocks and then recommendations from the experts, and then we have seen the positives and negatives. So overall for the 2023, if you have some amount, you can divide as a different percentage. So some percentage in IT, some percentage in banking and finance, and some other portions like defense and electric vehicles, some percentage gold, and some percentage small cap. So this is the way we are divided: 25% in IT and 25% in banking, and then another 20% defense, 15% for gold and metals, and another 15% for small cap. So if we put this way, definitely we are not going to be affected. At least we are going to see more than 15% or 20% return, that 20% is confirmly you can get as a return. So I hope that you may like this content. If you like this, please subscribe and forward to your friends. Thank you. Bye bye.